Hi, everybody. My name's Peter Turner, and welcome to our weekly podcast with here at ConnexionCFO. Today, I have with me Dharmesh Raithatha, whose background is CPO. Over the last 3 to 4 weeks, we have specifically been building a network of non-exec directors, primarily aimed at just giving some value back into our client base. One of the key requirements for us is that the non-exec directors have a domain expertise, and obviously Dharmesh's is our products. Dharmesh, would you just like to give a quick overview?
Hi everyone. My name's Dharmesh. I am a product coach, fractional CPO and NED, working with a range of different startups from pre-seeds kind of to Series B, and have a background in artificial intelligence, and then been doing product for the last 20 odd years, either as a product leader, a founder, and now as a fractional CPO or NED.
Brilliant. And so we'll get started on the questions. I guess the first question, and I've done 2 technology startups. How do you identify the product market fit in the early startup stages?
So, I think, this is an interesting one. So the first thing is, can you find a small set of customers that really love your product that they retain? So like the biggest indicator of product market fit is retention. Can you get people to use your product and come back and use it again and again and again? I think the interesting thing is where I see a lot of founders struggle is how much effort they should put into something before they launch it. The first thing I'd say is, so there's this nice concept called is your product a vitamin, a painkiller, or a sweet? So if you're targeting a pain, like a really deep pain, let's say I don't know, GDPR hits, right? Everyone has to change their company. It's like everyone's just out there looking for solutions immediately. What you want to do is build something and get it out as quick as possible, and don't care if it's a bit rough around the edges, because the pain is so acute that people will start using it and you'll get feedback very quickly. If you're building a product that solves a problem for people where their future self will be better because they use your product, but they're not feeling the pain today, it's like a vitamin, right? Like I take it every day in the hope that I avoid getting ill later on in life, but the effect of taking the vitamin today doesn't really make a big difference in me. Those products need to take a bit more time to communicate what it is that this product will do for you, so that you actually want to do it in the first place. So if you think of a fitness app, a health app, they spend a bit more time really thinking about how they communicate the benefit. And also I'd say that the product itself takes time to build and test to understand, is it giving that benefit? Is it engaging enough that means that people can stick around? And then the suites are more like your games of this world, which are very slick, very polished, go through lots and lots of iteration. Lots of games companies will try things, throw them away, because when you get it, you have one chance to make it stick in people's brains. They're not going to accept you just giving something rough and then iterating. All that iteration happens in the background, maybe with different types of users. And so the amount of effort you put in the product to get to some kind of product market fit is different in terms of the different type of product you're trying to solve for. And but ultimately retention is your biggest driver of indication. And then I guess the other one is like, product market fit goes in stages itself, right? Like you might start off with a product that is targeting a niche of your overall target market, and then say, can I get them to retain? And then once you get them, then you might start to expand. You might go vertical by vertical and you slowly build out to like much bigger product market fit. I've been lucky enough to work in, I think some people define that product market fit is when you really hit the jackpot of a company that starts, you really feel the pull, where the market just starts pulling you, you know. Before that point, it all feels slow and sluggish because you don't exactly know what you're building or what the customers want. And it's kind of like you've got a torch in the dark and you're just trying to figure out what is it that people want. And then you hit this moment. When I worked at Mind Candy, we worked on this kids game, Moshi Monsters, and you know, it flipped to, oh my God, this has just taken off. And suddenly it was like, you know, we can't hire fast enough. We have a roadmap as long as, you know, like so long, because we know that there's all this stuff that we need to suddenly build because the game has just taken off. And that kind of product market fit is, you know, that is, I think, what people think when they think of product market fit is this real pull on a company. But I'd say that there's stages before that of, you know, you're building product market fit in a slightly smaller market because you don't want to build a generic product for everyone in the beginning. You want to target a niche, make it work for them, and then expand out. But what I would say is, you know, true product market fit is when you feel a pull, sales starts to get easier, or if it's a consumer company, you start, you know, the marketing engine's working, it's profitable, and you can really scale. And you'll feel it on the company is like, oh wow, we need to move fast to keep up with the opportunity. Before that, it's this slightly more measured approach where you're really looking at, am I creating engaged users of my product?
You've got a little bit of a consumer-based B2C bias there. So in the B2B model, obviously, it can take a lot longer to identify the product market fit. Any thoughts around that B2B space?
Yeah, so I mean, you know, in the B2B world, you're right. Like, you know, especially if you're doing enterprise, it can be much slower sales cycles. You know, ideally, you're building your product together with a couple of interested parties, right? Who are like, hey, I like the idea of what you're doing. You've managed to convince me. Let's do either they'll help fund the development of it, or they're like very active in the giving you feedback on what you're building. And I'd say that there, first of all, can you take them from interested to actually using your product? Because even if you gave it away for free, most enterprises won't use it because of the commitment of training their staff and everything else. So, you know, can you get one or two to do that? And I always say that there's getting to 7 reference customers is this kind of tipping point where, you know, once you get 7 reference customers, suddenly things get a bit easier because you have the proof points. You know that your product works for a multiple set of companies, that now the sales engine can start kicking in and you can sort of start thinking about, how do I accelerate my sales process, hiring in salespeople, because I've got to 7 reference customers. So, but yeah, and the feedback loop is different on a B2B. You know, with a consumer product, you can launch it, you can do marketing, you can send people at it, see what happens, look at the data. You can A/B test your way through to something. B2B, it's much more about that relationship with your small set of customers until they get to the point of saying, I want to pay for this, I'm using this. And you can do that with at least 5 to 7 of them.
Oh, brilliant. And so you've obviously been you've worked with over 30 company launches, which is a lot. What do the successful founding teams look like that you have worked with, and why?
Yeah, so I was a partner at Forward Partners, which was an early stage VC fund, and we invested, you know, which is not usual, in a lot of founders that literally just had a deck, and we would have a team that would bolt on and help them build and launch the product. And you know, the first question is like, what you'd find that you get multiple founders coming to you with a similar idea. So why do you back one founder over another? I'd say that, you know, having deep domain expertise is one aspect.
Yep.
And obviously, you know, right now, like AI is, you know, very big. And so like technical founders that really understand how to use AI, I think is also important. So there's a coupling there. I've met lots of technical founders that have technology but have no domain expertise, and they struggle. I've met, you know, domain expertise who don't yet have the partner on the technical side, and they start to. It's an interesting one. If they've just got domain expertise, their biggest risk in their head is technical risk. Whereas if you come from the technical side, you know, you think like, well, if you can build a robot or a self-driving car, I can probably solve this technically. And so their biggest risk is like, actually, does the customer want what I'm building? And what I found with founders at the very early stage, how do you identify if they're good or not? One pattern I saw was, have they done something else in their past that was exceptional? And it could be like anything. So, for example, we backed Richard, who's the founder of Robin AI. They're a Gen AI legal startup, and they're doing really, really well. Super eloquent, but he was the coach for the English debating team. You know, so like there's this one thing he did exceptionally well, and you can see it translate into how he carries himself and how he knows how to pursue a goal. Because I think, like, you know, it's not like founders have this magic, but I think there's something in their past that you can pick up on. That's like, oh, they have the ability to be exceptional. I think that there's also this balance between belief at the early stages in what they're doing and the ability to take on feedback. And you always get exceptions. I'm talking about the general rule of what I experienced is the good founders had a strong belief in they were doing, but because it's such a early stage in a company and there's so much stuff to figure out, they were also able to take on advice, but still form their own opinion of it. But you felt like they are listening to that and they're open to learning. And their mind isn't completely closed off to it, because then they just run into down rabbit holes and they get lost.
Oh, brilliant. Really enjoyed that. We touched on this a little bit before, but and maybe you're going to extrapolate on a bit more, but you work for both B2B and consumer startups. I guess what is the key difference in terms of how they do product?
Yeah, so I mean, obviously there are different types of B2B companies, right? Some of them operate more as a consumer thing, where they're selling to maybe SMEs and it's self-serve product. So in that case, the marketing is slightly different in that the way that they attract customers, but they might be doing paid marketing. They'll probably be doing more content to drive, like, you know, SMEs to kind of sign up. But then the product creation process is very much similar to a consumer. It's like, what is the onboarding flow? How do they, how do they understand how to use the product? What is the core value that we're offering? Do we do that really, really well? That kind of overlaps. Enterprise, in some ways, is a lot harder because you have less customers. There is a real risk that you get your first customer and you end up building product for them, and you lose the ability to generalize and, you know, build a product for everyone. There's such a temptation to be like, you know, we really need this customer and they're asking for X, Y, Z. And then you start building for that. And then suddenly the whole product's skewed out of shape. But if you don't do it, you don't survive. So, you know, where's that balance? And I think that's a hard balance to do in B2B. I always talk about product integrity. You know, you kind of maintain the integrity of the product so that it serves many. But the realities of early stage startups is you also have to survive to get to that point. So having experience to understand the nuances of when to say yes and versus when to say no, I think is important. With the consumer side, generally, they're not painkillers. Or, you know, the effort to build something, it takes more time. There's more love that needs to go into the product. in terms of visually and how it feels and is used. And then obviously the marketing side is how do you get people to use your product? Is it viral? Is it expensive to acquire customers? The channels that you use to acquire customers can be very different. The interesting one is when you get to a bit of scale. So let's say you get to seed Series A and above. That's where you see internally how the product teams function can be very different. So, right now I'm working with this education company. They've raised 10 million. They're scaling. They've got 4 million users. They A/B test everything. Everything is a hypothesis. They can test it. They can launch it within a few days or a week, get feedback, look at data, and they can learn very, very quickly. And they've got very rapid cycles of building things and testing things and getting feedback. And then I work with another B2B company, like they've raised from SoftBank, much bigger. The way that they operate internally is like, 3-month roadmaps. It's harder to get feedback from customers. They can't A/B test in the same way, so they have to have more conviction, which means that the quality of the research that they do has to be better. So the B2B company has to do more research, understand their users very, very well, and then have conviction to build something that takes time, and then roll it out slowly, because they can't just A/B test their way to truth. The consumer company might still do those things, but they could also say, hey, we'll do some research and we'll launch something simple and get some feedback and see if that works, right? So like internally, the dynamics of how it's set up are different. B2B needs more conviction. Consumer have this option of A/B testing their way through and really de-risking as they build.
Brilliant. I do understand that there's like in B2B, I've done one B2B venture, one B2C venture, which we've just started a year and a half ago, and then I'm back to B2B. So I understand the difference between the two. What did you learn about the venture capital that you didn't know before starting with Forward Partners?
Yes, I mean, my background has been, doing product or as an engineer. And then suddenly I found myself, running a venture studio with Forward Partners. And it was very interesting. Firstly, I guess the first thing is that I didn't understand before that venture capital is, it's a B2B sales business, right? Like they have to attract, their customers are founders. And the weird thing is, even though the VCs have got the money, and there's tens of thousands of founders that would happily take that money, the very good deals, the ones that you want to get into, everything flips. They've got multiple VCs wanting to get in on that deal. And so how do you convince them to come to you in the first place and to take your money over someone else's? And so, all the best VCs have a great brand. They do a lot of content, or they found a way to convince founders that they should take their money over someone else's. And so internally, you're operating as a B2B model of thinking about how do I attract these founders to you. And then interestingly, if you're a new fund, things start changing once you've had successful exits, because then you've got your reference customers of we backed this founder who built this unicorn. And I did a study I interviewed loads of founders about why they picked this VC over that VC and what they're looking for. And, I found that the biggest one was founders believe in the idea, but there's still some self-doubt. And because it's early, right? There's still some internal doubt. And so taking money from someone that's already backed someone else that's been successful kind of makes them feel like, oh, if you've backed them and they're successful, and you're backing me, then I have a chance. Like you're some clever person that can see who's going to make it or not. And so you've backed me, and so I'm going to make it. And I think that's a powerful lever, but it's hard for early stage VCs to get to that point. And before that, they need to build some credibility in another way, whether it's the partners, operators, or they've had a successful exit, or they build this content and value add that makes them attractive. And then, the other one is like just we would look at 4,000 deals every year, which is a lot of volume. And out of that, we might make 12 investments in the year, right? So like, it's a real numbers game of pushing companies through a funnel. But fundamentally, as a VC, each fund might make 50, investments, let's say, to construct a portfolio, knowing full well that at least half are going to fail. Maybe two or three, you're relying on two or three to get very, very big, because it works on a power law. So like you're relying on two or three to get very, very big and return all the money that pays back everything else. And all the ones that sit in the middle may just about return the fund. And so when you understand that mechanic is typically what happens, you get so many founders that we would say no to who have a valid business, but they would never, it's not that they would never. We passed on many that became successful. But you have to help the VC believe this could be one of the three that become massive. And without that belief that it could become massive, like the returns just don't make sense. So like every investment we made was like, can this at least return the fund at the point that they exit? So it has to be a big market size. And a lot of founders go, yeah, but my idea is good. I've got customers. And it's like, yeah, that's fine. But is it a VC business? And that is, I think, the hardest thing for people to get their heads around. And fundamentally as well, like you are spreading your bets, right? As a VC, you don't have some prescient view of like who's going to succeed. You are constructing a portfolio that then luck plays its part in what succeeds in that.
No. And absolutely. Time again, I've seen the metrics from VC. So, you're also a product leadership coach. And where do you feel you have the biggest impact on a business, on a business?
So for the last 3 years, I've been doing a mix of coaching and fractional CPO work. I started off the coaching just as some people have asked me to do some coaching. And then over time, I realized how rewarding it was for me and for them. When I was working at Mind Candy and the company was growing really, really fast, the company goes through waves, right? Like we went from 20 people to 300 in a couple of years. And my skills, I was like, oh, we went from 20 to like 50. And I'm like, okay, I'm managing this. Then we went to 100 and I'm like, I'm managing this. And then when it went beyond 100, like my skill set wasn't scaling as fast as the company was scaling, because everything was changing all the time. And I think at those moments, a coach can really help you anticipate and think through how you deal with those changes. And there's a confusion I find between a mentor and a coach. So a mentor is, I will mentor people where I give advice about product. Oh, I've been there before, I've seen this, etc. And I see that as mentoring. As a coach, my job is to ask questions, the right questions that help you think through your problem, and have a sparring partner to work through a problem. But it's essentially building your own capacity to solve another problem in the future. Whereas a mentor is like, I'll give you the answer, you do that thing, but then the next problem comes along and you're like, well, I'm going to go back to Dharmesh to answer it. And it's like, but that's not what you want. You want to build the capacity within the individual to solve the problems. And so, if I'm working with a head of product or a CPO, like their problems are slightly different to like a founder. The first of all, head of product, they have a lot of often it's a founder leader issue that they're having to navigate. They don't have the full picture. They have someone above them that can change direction. I would say a lot of the people I coach at that level, dealing with their CEO is a big part of the energy of what they want coaching for, is how to leverage that relationship. Not always. Some are like, we've got a great relationship and it's more about how I scale myself and anticipate things. And then with the founders, obviously there's like, a larger leadership piece, which is more about company building, even though I specialize in products led founders. So often it's like two co-founders. One is CEO dealing with, maybe finance and investment, and the other one's in charge of product. But still, there's a lot more leadership issues to deal with. They're also thinking about, building out the overall company, managing a board, managing investment. How do they think about the product in order to get it investment ready? So, those kind of conversations are happening like within the coaching setup. And so you can see that when it works well and I feel satisfied is when they are anticipating problems ahead of time. But also that they have a space to just reflect on things and think things through because I've asked them the right question.
Yep. Yeah. And so one final question. It's a question that I see all the time is, how should the board develop from a startup idea through to maybe a scale up and then a growth business?
Yeah. So, there'll be a lot of startups up to seed that probably won't have a board. They might have some advisors to help them. I've been involved in a couple of companies where they have started from zero and they've created a little board, but the conversations are different, right? It's not like we're looking at company finances. It's more about strategy and developing the products and helping them think through. Yeah, because they're trying to find product market fit. The only strategy they have is find product market fit. That's the only goal that they have.
Yep.
And so that's the focus, and it's more about helping them, and that it's more of an advisor board role as they progress. So actually, it's interesting. I say to a lot of operator coaches or advisors, and they say, I've been invited to a board. I generally say to them, like, that's not the place where you're going to be most effective. If you're actually thinking of wanting to help that company in your capacity as a product person, then be an advisor where you can go into the company one day a week or whatever and advise and get in a bit into the weeds. The board is not the best place to give that kind of.
I agree.
Whereas like, the board is a useful function. If they've taken investment, obviously like the investor wants to be on the board. But I'm not investing and I'm on the board, and it's because they want someone who's got that holistic view. So I think my background of product plus growth plus company building plus VC like gives me that breadth to be okay. I'm useful on a board. I don't need to just be in the weeds doing product. And then where I find it's useful is, coming from a VC background, working as on multiple companies, I have just a perspective on how so many different companies are solving problems, that really helps a founder who's only in their company for like 3, 4, 10 years, whatever it might be. So having that perspective in the board is super helpful. I generally sit on boards from seed to Series B, and that's because at that point they're still working on product, and having a voice in the room that champions effort and finances and resources into developing products, I think is very useful, right? Like, because otherwise your board is made up of people that understand money, and they're just thinking about, well, why is there no revenue right now? Like, what, where it's like, oh no, hold up, we're not there yet. It's time to build more product or improve the product. So having that voice is very helpful, because I'm championing. Actually, might be championing away from saying we don't want to monetize right now. We want to build the product, get it right, get the metrics right, put effort on it. So I think that the value of having someone like me on the board from the up to that stage is because of that 360-degree perspective, but also I can champion and support a founder in thinking through what's important around product.
I agree. Dharmesh, thank you so much for this. I'm certainly very pleased that you're one of the non-execs in our portfolio. I love the domain experience around products, and also the ability or the experience that you've had inside that VC environment as well.
Yeah, thanks for having me.
Right, thank you.
Take care.
Bye, everybody. Bye.